It has been a season of records for the Indian export sector. India comfortably crossed the $400 billion export target in FY22 by $20 billion. Previously, outbound shipments had touched a record of $330.07 billion in 2018-19. And amid high commodity prices and the ongoing Russia-Ukraine conflict, India's merchandise exports swelled by 24.2% in April to $38.2 billion, the third highest level ever. Before this, the preceding month had seen record exports of $42.2 billion. The growth seen in exports in April was partly a function of commodity prices. Consider that petroleum product exports more than doubled, with a 113% increase compared to April 2021. Meanwhile, chemicals increased by 27%. But as a Business Standard editorial highlighted, there were also indications that the increase in exports of electronics goods had possibly become sustainable. In fact, exports of electronics goods surged by 64% year-on-year. Let us also consider the key drivers for FY22's exports performance. Exports of engineering goods jumped 32% in the first 11 months of FY22 compared to the previous financial year. It was the biggest export item. However, in April, exports of engineering goods registered subpar growth at 15.4%. Quoted in a previous Business Standard report, Engineering Export Promotion Council Chairman Mahesh Desai had said that high logistics cost and unprecedented increases in raw material costs had been hurting engineering goods exports. Although he saw the growth momentum seen in FY22 continuing. According to Desai, the trade deals with the UAE and Australia would give a boost to the sector, and the proposed free trade pacts with the UK and Canada would further add to this positive momentum. This brings us to two deciding factors that will impact India's exports growth going forward. First, how much of this growth can be attributed to the medium-term effects of higher commodity prices, and how much to the long-term effects of a more export-focused finished goods sector. Second, the impact of recent and future trade deals.
My assessment is definitely there is a price effect, but on the other side, I see the quantity effect as well. The commodities like petroleum products, if you see, definitely input prices have increased, but quantity wise, I definitely see a rise in this. Specifically in the chemical sector, if you see, the organic chemicals are doing very well. Some of the miscellaneous chemicals is also doing well in this sector. Apart from that, the iron and steel, cereals, electrical machinery, sugar confectionaries, plastics, pharma is doing great job with respect to the increment if we compare looking at the previous years. Look at the current India's FTA strategy. You will definitely find out a lot of commodities being ratified with UAE and Australia, which are very labor intensive. And definitely we will get a lot of scope for industries like textile, industries like leather, rubber, or gems and jewelry. These commodities will get a boost. And apart from the FTA strategy, I definitely see another important factor is the PLI scheme, which has been introduced, and government is persistently checking, monitoring, and screening the amount of exports and imports that we are doing under the labor intensive commodities, because they have a pressure to generate the employment and growth through these intensive sectors. It'll be enormous in future. So I definitely feel that current FTAs are are very different in terms of time. They are very time bound. They are looking at the policies. They are actually debating on the issues which are more contentious issues, and they're looking at the policies where they wanted to look at the industries from the holistic overview. In the sense that they are more of offensive in their interest rather than defensive. They know that which sectors to be exported, they know which sectors to be imported. They are very clear what needs to be offered and what needs to be taken. So I think in this case, the current FTAs that we have signed with UAE and Australia, it shows a very different picture of India as compared to the previous negotiations that we had. In this, we are looking at more comprehensive FTAs that India has signed, where India is looking at some of the new issues which they wanted to explore. They wanted to open the markets for them. And on the other side, in the coming FTAs with developed nations, India wants to give the signals to the world that we are ready for not only for the developing nations, but we are ready for the developed nations as well.
Recent developments also indicate challenges going ahead. The last week saw central banks across India, the United States, the United Kingdom, and Australia commence actions to fight inflation. This has translated into an increase in benchmark interest rates and also the withdrawal of excess liquidity, which had been injected during the past 2 years to counter COVID-19's economic impact. These steps are likely to result in lower global trade and economic growth. Then there are the disruptions in global shipping and supply chains due to the strict lockdowns in China and the Russia-Ukraine war. Amid all this, there are various measures that the government can take to secure exports growth. First, ensuring that competitiveness increases throughout the exporting sector, which will require an upgrade of both physical and soft trading infrastructure. Second, it must speed up new trade agreements that lower tariffs all around and enhance market access. On a related note, it will also have to leave behind the practice of raising tariffs to protect domestic industry. Finally, exporters will be helped by the weakening of the rupee against the dollar. The RBI should play a supportive role in this regard.
In future also, I feel the kind of targets which is being set by the ministry, or would be, I mean to say, they would be setting any targets, though they are setting the lot of targets for Export Promotion Council, respective ministries, to meet those targets. But yes, they are a little flexible also about these targets, looking at the current situations, and we don't know what could be the emerging situations in the future as well.
India's merchandise exports to GDP ratio has been on a declining trend. While this ratio will show an improvement in FY22, it will still be nowhere near the record seen more than a decade ago. It remains to be seen whether the government can reverse this trend.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.